Welcome to Iron Financial. This is the explainer, where we take an absolute sledgehammer to the balance sheets of Wall Street's heaviest titans. Look, our mission here is simple. We want to help you forge a stronger, unbreakable portfolio and cut straight through the structural weakness of the broader market. Today, we are conducting a brutal, high-stakes stress test on a true banking behemoth. We're talking about Bank of America. We cover them for one very specific reason. Their structural health is the ultimate proxy for the entire United States economy. When this bank flexes, the entire market shifts. So we are cross-examining their newly released Q2 2026 earnings report, and we're placing it side by side against the hardened bedrock of their detailed Q1 2026 and fiscal year 2025 baselines. Let's get to work.
All right, let's dive right into this by dropping an absolute anvil on the consensus estimates. Bank of America just reported a staggering Q2 2026 net income of $9.1 billion. That is a massive print. We're looking at a top-line revenue surge of 15% year over year, hitting $31.6 billion. Now, for those tracking our framework, top-line revenue is simply the total money brought in the door before any of the operational expenses are stripped away. That surge helped forge a diluted earnings per share of $1.21. Think about diluted EPS for a second. It means the actual profit per share if every single convertible security or stock option was exercised right now. And that number saw a massive 34% increase. In the high-stakes game of institutional banking, these numbers suggest an architecture that is incredibly robust.
Okay, hold your hammer for a second. I hear those top-line metrics, and yeah, they sound great. But as always, I have to ask the hard question. Is this sustainable, structural growth, or is this just highly polished accounting hype, masking a heavy paperweight? A $9.1 billion net income looks absolutely flawless on the facade, but we need absolute clarity here. Are these gains coming from real, load-bearing operational strength, or are they just the result of temporary cost shifting and some incredibly volatile trading anomalies? We can't just take management's word for it. Let's take out the magnifying glass and look for the hidden stress points in this blueprint.
Fair enough. Let's start phase one of our structural stress test, the macro drill down. We're putting Q2 directly against the Q1 baseline. We absolutely cannot evaluate the tensile strength of this quarter without knowing exactly what the foundation looked like just 3 months ago. Let's start forging a baseline. In Q1 2026, on a fully taxable equivalent basis, which, by the way, simply means the numbers are adjusted to make tax-exempt income perfectly comparable to standard taxable income, total revenue net of interest expense was sitting at $30.434 billion. Reported revenue was at $30.272 billion. Net income for Q1, a solid $8.584 billion. Now fast forward to Q2 and you can see they've bolted on some serious mass. They drove revenue up to $31.6 billion and net income up to $9.1 billion. Management is guiding that this is driven by broad-based growth across literally every major business segment. The structural integrity here looks undeniable to me. And look, a bank can grow revenue all day long, but if their expenses are expanding faster than that revenue, the foundation rots from the inside out. Notice the expense profile tightening up here. Bank of America is successfully smelting off the fat. In Q1 2026, the efficiency ratio was 60.89% on an FTE basis, or roughly 61.22% unadjusted. In Q2, they went in, tightened the bolts, and dropped that efficiency ratio down to a highly optimized 59%. Plus, CEO Brian Moynihan highlighted a 6.6% operating leverage. Operating leverage is absolutely crucial. It's the ultimate gauge of corporate engine efficiency. It basically means their revenue is growing significantly faster than their expenses. Management even lifted its full-year outlook, and they're now projecting 300 to 400 basis points of total operating leverage. Let me jump in here because I want to drill straight into the net interest income. Net interest income, or NII, which is the spread between what the bank earns on loans and what it pays out on customer deposits, is the actual lifeblood of traditional banking. In Q1, NII was $15.745 billion. In Q2, it bumped slightly to $16.0 billion. Now, management expects full-year NII growth to hit the upper end of its 6% to 8% range. But remember, that assumes fixed-rate asset repricing and a forward curve with a 25 basis point rate hike in September. So here's my question. Is a $255 million bump in NII actually enough to carry the heavy weight of that massive $31.6 billion revenue print? Or is this bank getting dangerously reliant on non-interest fee anomalies like investment banking and volatile trading just to keep the structure standing? That's exactly why we need to move deeper into the architecture. Section 2, Sector Stress Test, the load-bearing pillars. It is time to take a sledgehammer to Bank of America's 4 core business segments. We need to see which load-bearing pillars are holding firm and which ones might be quietly buckling under the pressure. The heavy lifting is undeniably being done by consumer banking, which generated an incredible $3.3 billion in net income for Q2. That's a 10% year-over-year increase, pulling $11.3 billion in total revenue. Right next to it, we've got the highly volatile but massive global markets segment. This is the arm of the bank that handles complex institutional trading and derivatives. They produced roughly $2.6 to $2.7 billion in net income. And by the way, that is excluding debit valuation adjustments, which simply strips out the accounting noise tied to the bank's own credit risk. Finally, we have global banking, handling corporate loans and large-scale underwriting. They are holding up their corner of the sky with over $2.0 billion. Now, to prove the absolute resilience of that retail foundation, we just need to look at the deposit base. Sticky retail deposits are completely crucial right now. Why? Because they provide the absolute cheapest source of funding to fuel the rest of the bank's heavy machinery, especially in a high-rate environment. In our Q1 2026 baseline, average consumer deposits were sitting at approximately $950.8 billion or $956.2 billion if you look at the exact supplemental data. In Q2, average consumer deposits rose again to $957 billion. They also bolted on 162,000 net new checking accounts, bringing the total up to a record high. The retail foundation isn't just rock solid, it's actively expanding. Average deposits have now risen for a 12th straight quarter. You cannot fake that kind of structural strength. Let me tap that consumer pillar with my hammer for a second, because deposits are only half the equation. What about credit? I am hunting for cracks in the consumer credit profile. If we go back and look at the Q1 baselines, 30-plus day card delinquencies were sitting at $2.512 billion, and 90-plus day delinquencies were at $1.341 billion. Now, management claims that in Q2, consumer card charge-offs and delinquencies improved both year-over-year and sequentially. That sounds reassuring, right? But wait. With total card spending increasing 9% to $266 billion in Q2, we have to stay highly vigilant. If the macro environment suddenly cools off, that expanding credit card balance could very quickly turn from a nice revenue generator into a massive structural liability. I hear your caution, for sure, but let's pivot and point to the massive trading engines driving the global market segment. In Q1 2026, global markets produced a net income of $2.007 billion. But in Q2, net income, excluding those debit valuation adjustments we talked about earlier, rocketed up 70% year-over-year to $2.7 billion. Sales and trading revenue spiked 33% to $7.2 billion. How did they do it? Equities revenue hit an absolute record of $3.6 billion. Meanwhile, FICIC, which stands for Fixed Income, Currencies, and Commodities, essentially the trading desk dealing in global bonds and foreign exchange, they pulled in $3.5 billion. That marks its strongest quarter in over a decade. This entire segment is an absolute furnace right now, drastically outpacing its Q1 baseline. True, that's a huge quarter for trading. But let's be real, trading engines are notoriously volatile. They run hot and then they freeze. Let's evaluate the wealth and corporate pillars to see if they offer a more sustainable structural alloy. In Q2, Global Wealth and Investment Management, or GWIM, pulled in $1.4 billion in net income on record revenue of $6.9 billion. That's up from Q1's $1.329 billion net income. Meanwhile, global banking generated over $2.0 billion in net income, barely edging out its Q1 baseline of $2.087 billion. But here's the catch. The key driver here? Corporate investment banking fees, excluding self-led transactions, surged 50% to over $2.1 billion. Corporate investment banking fees, like massive mergers and acquisitions advisory or heavy debt underwriting, are highly cyclical. We have to ask, are these fees structurally permanent or just temporary market exuberance masking deeper issues? So the crucial point is this. We've spent plenty of time looking at the income statement, but now I'm taking full control of this explainer. I want to turn a high-powered flashlight into the deep, dark foundation of the balance sheet. This is the balance sheet and credit quality audit. We are hunting for hidden stress points, toxic assets, and capital inadequacies that the polished top-line numbers might be bearing. Go ahead and scan the foundation, but I'm telling you, you're going to find it wrapped in thick steel. Just look at the capital adequacy. Bank of America ended the Q1 baseline with over $200 billion in common equity Tier 1 capital. That keeps the CET1 ratio, which is the ultimate regulatory measure of a bank's core equity stacked against its risk-weighted assets, ironclad at around 11.2%. That is well above the regulatory minimums. They're generating massive excess capital, and they're consistently deploying it to support asset growth across all businesses. And they're doing all this while still returning massive capital to shareholders through stock repurchases and dividends. A strong CET1 ratio is nice, but I want to drop a bombshell right here that management tends to breeze past on their calls. What about the massive, hidden paperweight sitting on the balance sheet? If we look at the Q1 baseline data, Bank of America had roughly $514.7 billion in held-to-maturity, or HTM, debt securities. Because rising interest rates naturally cause the value of older, lower-yielding bonds to plummet, that specific portfolio was carrying a staggering $81.1 billion in gross unrealized losses. Now, if a severe liquidity crisis forces the bank to sell those bonds before they actually mature, those theoretical paper losses become realized destruction. Can this framework hold up if the market suddenly demands liquidity faster than the bank can naturally optimize its balance sheet? And let's move forward and see how this builds into their credit risk shield. We need to analyze the credit risk reserves with absolute clarity. In Q2, the provision for credit losses, which is the quarterly expense taken directly on the income statement, was approximately $1.4 billion. Now, that's largely unchanged, just a slight bump from the Q1 baseline provision of $1.337 billion. Furthermore, looking back at the Q1 baseline, the total allowance for credit losses, which is the massive stockpile sitting on the balance sheet designed to absorb actual defaults, was sitting at an aggregate $14.3 billion. We need to fiercely debate whether a $14.3 billion allowance is a strong enough shield for a total loan and lease portfolio that expanded to $1.22 trillion in ending balances in Q2.
And when we talk about that massive trillion-dollar loan portfolio, we absolutely must zero in on the ultimate potential fracture in the concrete, commercial real estate. Based on the Q1 data, Bank of America carries an outstanding commercial real estate exposure of roughly $69.6 billion. Now, management noted that in Q2, reservable criticized commercial exposures actually declined by about $2.3 billion, bringing it down to roughly $22 billion. They claim commercial credit remains solid, with those improvements offsetting isolated corporate lending losses. But in this current macro environment, with post-pandemic office space vacancy rates remaining stubbornly high in major metropolitan sectors, commercial real estate is an anvil hanging by a thread. I am not entirely convinced that allowance shield is thick enough if office space defaults trigger a massive chain reaction. All right, we've hit the numbers hard. Let's move to Section 3, the final ironclad verdict. The data has been laid out, the stress test is complete, and it is time to deliver our definitive conclusion on Bank of America stock. My final, forceful pitch is this. Bank of America is forged in absolute iron. When you can deliver a 17% return on tangible common equity, meaning massive profit generated directly from actual hard physical capital, and you drive average loans up 8% year over year to $1.2 trillion, this stock is a screaming buy. The relentless 6.6% operating leverage proves they are hyper-efficient right now. The net interest income is growing, the trading engines just posted record decades, and the retail deposit base is expanding. The structure is built to withstand massive market pressure. And I'll issue a final warning. This could very well be a highly polished value trap. Yes, the Q2 earnings were spectacular, no one is denying that, but they are heavily reliant on cyclically volatile investment banking fees and record trading surges that might not repeat next quarter. Furthermore, you simply cannot ignore the heavy paperweight of the held-to-maturity unrealized losses, nor can you completely brush off that $69.6 billion exposure to commercial real estate. If the macroeconomy falters, those cracks in the bedrock are going to spiderweb rapidly. Well, the heavy lifting is done and the stress test is right there on the table. Now the final decision is yours. Will you forge your portfolio with Bank of America's relentless top-line growth, or will you stand back and wait for the structural cracks to show? Look, if you want to survive the heavy machinery of the stock market, you need to subscribe to Iron Financial right now. Hit that button, build an unbreakable portfolio, and drop your own structural verdict on BAC down in the comments below. We will see you on the next Deep Dive Explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.